Hello everyone, welcome back. I got some really good ones for you today. But first, I hope your week is off to an awesome start. Markets are pretty boring today. Three major stock indices not really doing a whole lot. 10-year yield came up slightly, but whatever. Not really a whole lot going on in the markets following the action we've seen in the three major indices over this last couple weeks. So as that 10-year yield dipped from 3.5% about a month ago down to where it's at now, like 2.8, that let the NASDAQ, Bitcoin, oil, gold start recouping some of these losses and moving up quite nicely. About a month ago, we did the 74 inverse Cramer video. You can go check that out at NASDAQ 11,500. Cramer, Elon Musk, Cardi B, Robert Schiller, every economist, banker, and entrepreneur on planet Earth, they all flipped bear around the time of that video. Cramer was saying to sell the NASDAQ at 11,500, run away, go to value stocks, go to cash, recession-proof your portfolio. The next day, the NASDAQ bottomed at 11,000, now it's over 13,000. So would have gotten a 2,000 point move higher in the NASDAQ had you done the inverse Cramer play. Now yesterday, Cramer came out and said to buy Microsoft, Tesla, Apple, all high growth tech stocks on dips. So now that Cramer's told you to sell Microsoft, Apple, and Tesla at NASDAQ 11,000, now that the NASDAQ's over 13,000, he says to buy the dip, maybe sell. So they're kind of messing with our heads, or they're just wrong, right? But we talked about how the yields would mysteriously start to fall as a function of the Fed buying bonds, driving the yields down, stabilizing the debt market, pushing asset prices up, making inflation worse. You're seeing all of that. PSYOP going on, another PSYOP other than Cramer telling you to sell tech stocks a month ago. Another PSYOP going on is this idea that the market is waiting for inflation to peak, and once the market gets the green light that inflation in the domestic economy has peaked, then it can move higher. I'm not seeing that. In my opinion, as inflation remains white hot in the domestic economy, asset prices have room to move higher with it, because the PSYOP right now that prices for groceries and gas are going to keep skyrocketing, destroying the middle class, and that's going to cause a housing crash. I don't see it. I see, because if that were to happen, any sort of uncertainty in housing or deflation, which actually we're getting it. We got a housing number this morning. Housing starts came in below the last bout of numbers and below analyst expectations as well. So housing starts took a little bit of a wallop this morning, but it doesn't necessarily create deflation in housing around that uncertainty, because the Fed responds by saying, well, we're just going to keep interest rates and bond yields lower for longer. The market reads that as a lower for longer type monetary policy, which means more accommodative, not less, which means more easing, not tightening, like the Fed's been telling you, and that sends markets higher. So I think as the 100 grand a year becomes a middle class income for people that live in America, I think as the currency continues to collapse, real wages continue to collapse in the face of massive inflation, I don't think asset prices are going to be deterred by that. I think they're going to continue to march higher, and you're seeing that because inflation is good for asset prices. It's part of the banking sector's bread and butter to remain accommodative and pump markets at all costs, protect their benchmarks in the equity markets, protect their benchmarks at any and all costs. And if we're missing growth through that process, throw it onto the back of a weak dollar, stoke inflation. So got a few PSYOPs going on out there lately. Another PSYOP is Jamie Dimon at JP Morgan. He's the CEO of JP Morgan. Like yesterday, I believe it was yesterday, came out warning of something worse than a recession. Okay, well, we're in a recession right now, so worse is what, a depression? Because I don't think the Fed is going to allow for the deflationary debt detox that it's a PSYOP. The big sell is that the Fed is about to tighten its balance sheet, roll its balance sheet off from 9 trillion down to 2 trillion, raise interest rates, and burst all these bubbles. And create a massive bid and flight to safety in the dollar and cash. That's like the big sell. I don't buy it. I think billionaires are going to stay 1% cash as their allocation, like they always do. I think worse than a recession, sure, like as in an inflationary recession, like a 2008, but prices also double over that same time, and you don't get a QE 1, 2, 3, 4 that creates mysteriously no inflation in the domestic economy like we had last credit cycle. I think Fed's, going to do QEs, yield curve control. I think the Fed balance sheet's ultimately going to go higher, so not lower. I think interest rates are going to come slower, not faster and more aggressively. And I think ultimately that's just going to make inflation worse, asset prices inflate, and engineer a two-tier society. So they'll kind of finish what they started in 2020 when they added 40% to the money supply and then told you that there would be no inflation, then said it would be transitory, then said it had peaked, then said it would peak, then said it hasn't peaked. I would expect this to continue, okay? So I say going into the end of the year and then next year, asset prices are going to continue to inflate as a function of the 10-year yield and interest rates in the dollar being very low. And those asset prices are going to inflate regardless of good or bad news coming out for the economy. If anything, good economic news would prompt the Fed to have to act more aggressively in its monetary policy and getting inflation under control, and that would send markets lower. So we could be in a situation now where as housing starts come in bad and numbers just come in paltry or below expectations, that just sends markets higher because the market says, okay, Fed's going to leave interest rates lower for longer. Fed's going to do yield curve control. So yes, in a free market would slow growth, destruction of small businesses, destructions of the middle class, would that create a massive deflation in kind of a Great Depression era style environment? In a free market, would that happen? Absolutely. But do we have one? No. So I would expect the opposite, kind of an inflationary depression, if you will. Prices to always be outpacing the wage growth until the Fed raises interest rates above the inflation rate. So like way higher than where they're at right now. And they couldn't even deliver a 1% hike at the last meeting. And then now they're going to barely maybe do 175 basis point hike and then go to baby bumps against the backdrop of 20% inflation. That's the collapse. That's the worse than a recession that Jamie Dimon is warning about, I believe. A 2008, 9, 10, 11, 12 style recovery, but with tons of inflation. And they don't have the free lunch of exporting all this inflation like they did last credit cycle without getting inflation in the domestic economy. I think that's over, and we're going to start seeing that inflation stick around in the domestic economy, and then a Fed drag its heels, a Treasury drag its heels on raising those interest rates and rolling off their balance sheet. They don't want to. Okay, another psyop out there is that when the Fed balance sheet goes higher, so it's at 9 trillion right now, there's this idea that if the Fed balance sheet keeps going up, and so let's say it goes from 9 to 18, that will bankrupt the Fed and bankrupt the country. No, that's the Fed's power. That will make the Fed twice as powerful as they are today. And so do you think the Fed, it really wants to roll off their balance sheet from 9 trillion right now back down to 2 trillion via quantitative tightening? They're telling you that because it's going to get inflation under control, but do you really believe it when their power is that balance sheet going higher? So I think ultimately the Fed balance sheet isn't going to get rolled off nearly what they say it is. They don't want to give that much power away. And they're underwriting the whole global economy. So I don't think that they're going to stop doing that. And I'm not just trying to pick on the U.S. and the Fed and the Treasury, because this is a global phenomenon, all right? So if you're getting this idea in your head, well, this is the end for America and New Rome. I'm going to run away to another country and expat, to a place with worse inflation, worse security. Like, there's nowhere to run. So the Titanic is going down. The Fiat Global Ponzi scheme is the Titanic. The dollar is the world reserve currency at the top. It's sinking in absolute terms, but if you tried to run somewhere to another country or something, you're just running down into the Titanic while it's sinking. Okay, that's kind of how I look at it. Now, there is a Bitcoin lifeboat, get to it. There's a oil lifeboat, get to it. NASDAQ, gold. Those 4 lifeboats do really well in an environment of lower interest rates, lower yields, and a weaker dollar. So I say to go those, but I could totally be wrong. But you see, they're trying to keep you off balance and confused. 1 minute inflation's good for stocks, 1 minute inflation's bad for stocks. 1 minute housing starts going up is good for real estate. The next minute housing starts going down is bad. You see what they're doing. So if housing starts today came in and that number came in below expectations, and this is quote unquote bad news. Well, all the market says is, okay, well then the Fed is gonna keep rates and yields even lower for longer. And if that's the case, then housing prices keep going up. And if you're wondering, well, how can prices keep going up? Well, if no new supply is coming on the market, because you have a big demographic issue now, which is a global issue. So the baby boom generation is unprecedented globally. The whole world is going through the baby boom demographic headwind right now. And so if new homes aren't coming on the market, and we just kind of have like a fixed supply, and then more and more people trying to chase that fixed amount of square footage, well, there, you can keep your real estate prices inflated just based off lack of supply coming into the market. But real estate isn't so much a supply-demand thing. That's a psyop for you. It's really more what mortgage rates do, monetary policy. If you have friends in real estate, they'll tell you, I don't really know what interest rates are going to do. Like, I can't tell you if mortgage rates are about to move a lot lower or move a lot higher. And if they do, they usually don't really know what they're talking about, because mortgage rates are moved based on the debt market. Those moves are all based off what's going on in the bond market. So if you find somebody in real estate that also understands the bond market and the debt market and interest rates and yields really, really, really well, he has a clearer picture of what's going on in real estate than an agent that's like, oh, I know this location really well, and if you open a coffee shop down there on 2nd and McDonald Street, you're gonna make a lot more money over there versus the west side of town. Like, that's not the way to look at real estate. Start with the big picture, and the big picture is those mortgage rates. If the market is expecting lower mortgage rates, then expect house price tags to go up. And if the market is expecting higher mortgage rates, expect house price tags to go down. First 6 months of this year, Fed's been promising higher rates, but they're starting to back off from that. The Fed doesn't want higher interest rates. Interest rates moving higher can put mortgages at like 7%. That's the danger zone. So Fed, Treasury, banks, they'll protect their asset classes, and they'll keep interest rates and yields suppressed, and that'll allow house price tags to continue to march higher. I hope wages can keep up, but they're not. That's the big issue. So given our macro policy backdrop, the move is, in my opinion, not to wait for crashes and great deflations. The move, in my opinion, is to have your wage keep up with the cost of capital, which is now like 15-20% a year. So if your left shoe goes up 20% because they just added another 20% to the money supply, well, I would expect your stocks, real estate to do the same thing. And you need to make sure your wage is doing the same thing too. So if it's not, that's a wealth transfer from you to the guys upstairs, the beast system, right? So Bitcoin is a really good lifeboat. Gold is a really good lifeboat. Oil's a really good lifeboat. Nasdaq's a really good lifeboat, because those all compete toe to toe with the dollar, things tied to the dollar, and the debt market. So there you go. I like those 4 risk assets. I could totally be wrong though. I kind of hope I am, because I'd like to see the Fed raise interest rates like a lot more aggressively. I'd like to see inflation come down on its own. I'd like to see a free markets and flexible prices. So I'd like to see the Fed get out of the debt market, cause the 10-year yield and interest rates to skyrocket, and then that would be the great deflation, the debt detox that so many fair market people are waiting for. People are looking at these charts of like the NASDAQ. You see that thing going straight up for the last like 10 years, and you're like, oh, I think it's gonna fall all the way back. I think it's gonna go up half of that. It's not how it works. Fed doesn't want to see you win. They're gonna keep asset prices inflated. They believe that if they protect those asset prices, it ultimately protects the economy, even though that's a psyop, because they're completely different things. The financial sector and the real economy are completely detached from each other at this point. But the Fed thinks if the more they can pump the financial sphere, the more it's going to help the economy. So they're just going to keep pumping the financial sphere. All markets are trading on expectations around Fed policy, all right? So be keeping an eye on that Fed balance sheet. Keep an eye on the Fed. FOMC meetings tomorrow, so you will get the Fed minutes come out tomorrow. And then Kashkari, Fed President Kashkari on Thursday. Kashkari is the doviest dove to ever dove. Fed President Kashkari said in 2020, we have unlimited money at the Federal Reserve, and yet everyone in the country kept working. I guess they have If you come to my house every day and clean my windows for $200, and I have a machine that prints infinity money, you're my slave. So the Fed, Neil Kashkari, hey, They have unlimited money at the Federal Reserve. So I guess your wage is now unlimited. Should be, because if it's staying at 30 grand while they say things like we have unlimited money at the Federal Reserve and we're gonna print money and don't worry, the inflation won't happen. Don't worry, it's transitory. Don't worry, it's peaking. Oh, I guess it's not peaking. Don't worry, it's gonna peak. As long as they can keep feeding you that, your wage has to keep up, okay? And so yes, the dollar has big issues, but so do all the other currencies. There's nowhere to run there. So just get to your lifeboats and hope for the best. But that's just my opinion, and I could totally be wrong, just trying to give you an idea, at least for where I'm at. So we talked about Cramer, we talked about Jamie Dimon, we talked about the FOMC meeting coming up, President Neil Kashkari, we talked about just kind of market expectations around rates, we talked about the housing starts. So yeah, let's just keep going. Kind of a boring day in the markets, but I'm bullish out on the end of the risk curve. So I don't see the dollar getting a massive bid. I don't like the dollar suspenders, dollar under the mattress, and the billionaires who are all 1% cash right now, they're not about that either. They're gonna stay 99% equity if they're smart, and they're gonna be out as far in on the risk curve as they can go, and they're gonna be buying things like Bitcoin, the NASDAQ, oil, and gold. Could totally be wrong, kind of hope I am. But we're just gonna have to see. That's your update for now. I'll be back, and like, subscribe, whatever. Till next time.